gave me something, but yeah, good to know. So why is
Chairman Powell, money machine going brr. Chairman Powell, he ain't playing, this a blur. Gotta follow the data, ain't no time to err. Watch him speak now with that Tom Crown flair. Yeah, Chairman, he's the captain of the crew, navigating through the markets, knowing what to do. Federal Reserves in control, making moves, keeping that money flowing so the economy can groove. Chairman Powell, making paper every hour. Chairman Powell, he got that money power. Hater on his side, watch him rise and devour. Yeah, he's the chairman of the board, making moves that empower.
Welcome back, fam. Today we have another episode of the Chairman Powell World Tour, our favorite celebrity and chief of the U.S. finance. We follow him around. We are the home of the FOMC. We started doing them first before every major news network caught on and all your other favorite channels, but that's fine. I'm glad you chose to be here with us today. Powell himself going to be speaking in 7 minutes. Currently, some other lady is speaking. They are at the bankers finance some banking thing in Amsterdam. So Chairman Powell may be a little 420'd up. Speaking of which, smash the likes and subscribes, guys. Let's hype this stream up. It is early. I'm not usually awake. You're probably still sleeping, but we have to follow this man. Every word he says impacts the market. Really quickly, to kind of give a little background of what's going on today outside of this speech, we have some mildly important data that Chairman Powell probably will be looking for during this speech. We have PPI and core PPI. These are measures of inflation coming in year over year and month over month for April. We see core PPI up against forecast at 0.5%, forecasted at 0.2. That's a pretty big miss. Now, more importantly, year over year remains at forecast, but still up from the previous year over year in April. So not actually seeing inflation cool. Going to be interesting. Off the back of that, and really not related at all, GME blasting. GME, I believe, traded to like 80 in post-market, open today. Let's pull this down. Open today all the way up at 64. That's going to be, man, even since the start of May, that's a 500% gain. GME doing some crazy things. Shout out to our apes. They're our stock counterparts here at Bitcoin. You guys will find your way over to our fam at some point. I believe in you. You're intelligent. Well, you're as intelligent as we are, so it's all good. As well, we see AMC getting those January 2021 vibes on hard. AMC pulling a similar move from May's open at $2.80, a 318% gain. Wild stuff. Now, Bitcoin sitting kind of on the sidelines at the moment, trading sideways. Have this little channel. This channel, you thought we had left it. We didn't leave it. Just briefly, we came back. This channel haunts us again. We followed this all through the end of 23, and now seems like price is back in it, and not just back in it, but reacting to it. On our fall in the 29th of April, we rejected off the top of this channel. We fell into the middle on the 6th of May, retested it, fell currently at a higher low. So for the moment, the bleeding has stopped. We can see some very serious interaction here in the middle of this trend line. Interesting. Even in this 6-hour candle touching the middle of the trend line, wicking back up. I have a feeling that things might get a little spicy here in just 4 minutes when Chairman Powell is live himself. Guys, please make sure you've subscribed, hit the like buttons. We need the hype today. We need it. We need to keep me awake. I'm going to fall asleep in this chair if we don't have enough hype. So I appreciate everyone who is here today. Make sure you join our Discord, discord.gg/TomCrown. All kinds of goodies in there, educational content, as well as you'll get access to our free VIP section, or exclusive VIP section, should I say, for free if you sign up with any of the sponsors in the video description below. Easy peasy. Shout out to 𝐿𝐸 and Meta Signals, the best in the biz. And here we are, guys. By the way, if you see a very thin stream, very tall, very thin, you're on the mobile stream. A lot of you guys are still confused about this. There are two streams simultaneously. One is the vertical stream. That is for phones that you're on. If you are not on a phone, but you found yourself to that stream, navigate on over to the main one. Just click on the channel, go to the streams. You know how to do it, guys. Let's see what's up with the chat, man. I see 𝐿𝐸. How you doing today, my friend? I saw you streaming last night. I think you had some good numbers. What's up, Kai? The beautiful Kai is here. If you have 𝐶hirPow emojis, put them in chat. Give us a little 𝐶hirPow in the morning. When 𝐶hirPow, seal them. 3 minutes. 2 minutes, 3 minutes. We're waiting for this lady to wrap up. I'm not really sure what she's talking about. It's a very pretty pattern there she has. Maybe she's an artist. Nah, she's some kind of banker. All these people are bankers. I have her on mute for now. Well, very low. GME and AMC, man. What do you guys think? Up or down? Did they have more gas in the tank? Are we going to see higher highs today? Or do you think the rally's done? This really does have those 2021 vibes. I'm liking it. We saw GME, AMC go wild in early 21. We saw meme coins follow, Doge, SHIB, whatever. And then we saw the entire market explode. So we could be at the precipice of that same event. I think I will be more confident in that call once we see GME break its 2021 high. Now, yesterday when we looked at this, it didn't quite look like that was on the table for May, let alone even this year. The rally was very exciting, but it hadn't really gotten us anywhere. Overnight, post-market trading, these things have gone wild. In fact, GME, during post, traded all the way to its highest monthly resistance. Now, it's not reflected on the chart because it wasn't during normal trading hours, but that's some wild stuff. That is absolutely a signal to the market that this thing may have some more gas in its tank. What do you think, chat? I'm just burning these 2 minutes. We got like a minute and a second left.
What I like about this model is that
Pulling up the chat.
it's still so relevant. I love that.
What's up, Priest? How you doing, man? GME BTC pair. We did actually look at that on yesterday's stream. It looks just like every other BTC pair in the world. Risk on, says Spoon. Super Balls, says Wick. Sure, man. Meme coins GME equal blow off top. I do think we will see that. We use the words blow off top often, but what a blow off top usually is describing is a big short squeeze. It's a short squeeze that squeezes into a liquid sell, book, order, whatever, and essentially sends the price flying. However, there's no real sustained buying to keep it up at those prices, and we see a collapse. That is almost how all the blow off tops are. Even if they don't have a leverage squeeze position, it is still the same mechanic at play. Pegless, 108K subs, nice. Yeah, we did. Dude, we went from 95 to 108 fast. We were at 90 something in March. Now we're at 108. We got our live subscriber count right here on the short stream and way over there on the long stream. Hit those buttons, make that counter spin. It's very satisfying, I promise. It's worth the click. It's worth it. What's up, Philly Skills, my guy? Actually, let's look at these yearlies for a second. Taking a look at this GME yearly chart, we are above even the 2021 close that settled out at $36.46 currently during traditional market trading hours, 55.69. Nice. What about AMC? All right, this lady is officially 7 seconds over. She should be wrapping up shortly. AMC, a very different picture here. AMC, a little scarier. This drop, much more dramatic and even kind of more eye-catching to me. Even with this monthly rally, AMC just barely testing January 2021's open. Like, AMC way up here over the highest yearly close, or GME. AMC down here underneath what was support, potentially finding resistance. Honestly, if I had to pick GME or AMC for the rest of the year, I'd go GME. Hot take, not hot take. When does he speak, Ali? He should be speaking like right now. He is supposed to speak at exactly 10. It is 10 and 53 seconds. This lady should be wrapping up, and that's actually a really good reminder to get this situated. Let's make her a little bigger here. Any minute now, lady. Any minute now. We got it. Chair Powell is a little bit of a celebrity, and so he does like to be fashionably late at times. Actually, it's good she's running over. That works out, because we have one more chart to look at of interest and importance. And I'm going to get sick of saying it. I'm already sick of saying it, but we're going to look at it anyway because, man, this is a spicy chart. Pepe, not my favorite project, but Pepe, one of my favorite charts at the moment. Pepe broke its all-time high against the dollar yesterday, kind of as an outlier in the market. Not only did it break against the dollar to an all-time high, we also saw the exact same move, and this actually front ran it, giving us a little bit earlier of a signal than the dollar. Pepe against Bitcoin broke to an all-time high just before it broke its dollar all-time high. Now, today, and actually this morning, Pepe has pushed higher in both its Bitcoin pair and dollar pair. If you guys tuned in yesterday, that was a great stream, actually. We went through and I challenged you guys to find charts that had hit all-time highs against Bitcoin, and we struggled. With 1,000 plus 2,000 viewers, we struggled, guys. I said this is something that is not to be taken lightly. This doesn't really happen like this often. And so we've seen follow through. I can hear her wrapping up. I can sense Chair Powell's energy is descending upon us. Last thing I want to show you while we wait for him, because he always takes a minute. On May 4th, if you follow me on Twitter, at @TomCrownCrypto, May 4th, and in the live streams, I tweeted Pepe new all-time high baking. This was over a week warning. We gave you Pepe all-time high before it happened. Maybe it's worth the follow on Twitter. I appreciate you guys. Chair Powell now coming on in. This guy's introducing him. Let me turn up the volume. Let's get ready to rumble.
Over the years, Mr. Powell has gained a reputation of consensus builder and problem solver. On 𝐂𝐡𝐚𝐫𝐭 then.
How's the audio?
Mr. 𝐂𝐡 has been president of the Dutch Central Bank since 2011. In that capacity, he is also a member of the Governing Council of the European Central Bank. And in addition, since 2021, Mr. 𝐂𝐡 has been the chair of the Financial Stability Board, the international body that monitors and makes recommendations about the international financial system. Also, he's a professor for monetary stability at the University of Amsterdam. Claire Jones will be moderating today's interview. Mrs. Jones joined the Financial Times in 2011.
Is that any better?
Initially covering the UK
Their
and the
audio is
Eurozone,
terrible.
living in Frankfurt. And today, she is the US economics editor. She's been covering growth and the rates environment intensely. And she's also calling herself a bit of a geek in keeping track of what central bankers do. I'm super happy. Please welcome on stage Claire, Mr. Powell, and 𝐂𝐡𝐚. Hey, Claire, I'm leaving it to you. Thanks very much.
Chair Powell, let's get him on here. Chair Powell. Chairman Powell.
Me, yeah? Or are you in the middle? No. Okay.
Hello there. It's a pleasure to be here today in this wonderful venue. My name's Claire Jones. I'm the acting US economics editor of the Financial Times, and I'm here today with President 𝐂𝐡 and Chair J. Powell. Chair Powell, I'd like to begin with you. Could you give us a brief summary of the US economy and where Fed policy is right now?
Thank you, Claire. I'd be delighted to. Let me say it's great to be here. Thank you for being here. And 𝐂𝐡, thank you for this great visit I've had here to Amsterdam. It's a pleasure and an honor to be here. So the U.S. economy has been performing very well lately. We had growth last year of just over 3%, quite a strong year. And it's driven by a number of things. I would point to a very strong labor market where you've got rising employment, you've got rising wages, so disposable income, consumers are spending. Generally, households are in good shape financially, they're not over-levered, and so we see a good picture. Consumer spending has held up very well. As well, business investment has been strong. Businesses are seeing opportunities to invest, and that has helped. I would also point to a fairly large influx of immigration into the country over the past couple of years. And those people are joining the labor force. We're experiencing still a labor shortage in many industries, and so there are jobs, and they're going to work and they're consuming, so that's also boosting growth. So overall, a good picture looking at the data so far. The labor market is very, very strong. It was, I think, overheated a couple of years back, and what we've seen is it coming back in gradually into a better balance over the last couple of years. And now I think if you look at a broad range of data, you could say that the labor market is about as tight as it was before the pandemic in 2019, and that's good. Wages real wages are now positive. And unemployment has been below 4% for 27 consecutive months, something that hasn't happened in a half century. So, labor market very strong, and again, signs of gradual cooling and rebalancing, so that supply and demand of workers is coming back into balance, which just as we would want. Inflation, it's worth starting with the fact that on a 12-month basis, headline inflation got as high as 7.1%, is now down to 2.7%. Core inflation got as high as 5.6% and is now at 2.8%, so it's down by half. That progress, though, really happened over the course of last year, and particularly the second half of last year. The first quarter in the United States was notable for its lack of further progress on inflation. We had higher readings in the first quarter, and higher than we expected. We did not expect this to be a smooth road, but these were higher than I think anybody expected. And so what that has told us is that we'll need to be patient and let restrictive policy do its work. If I turn to the outlook just for a second, I would say we expect continued growth, 2% or better. We expect the labor market to continue to be strong, but to move further and further into balance. And I expect that inflation will move back down on a monthly level, on a monthly basis, to levels that were more like the lower readings we were having last year. Dovish. I would say my confidence in that is not as high as it was, having seen these readings in the first 3 months of the year. So we're just going to have to see where the inflation data fall out. And I'll stop there with the economy. Thanks.
Thanks very much. We'll be digging into some of that later in the discussion, but now I'd like to turn to President 𝐂𝐻. Could you maybe give us a little bit of a sense of how you judge the state of play in the Eurozone and here in the Netherlands?
Yeah, I think the state of play in the Eurozone is not entirely comparable to that of the US. We just came out of more than a full year of economic stagnation. Now, luckily, the signs of recovery are clearly there. We started off the new year much stronger than we had expected. And if you look at the soft indicators, that recovery is expected to continue into the second quarter, and it's even expected to accelerate in the second half of the year. And this is mainly on the back of ongoing recovery in real wages, ongoing recovery in purchasing power, and strong consumer demand. Now, there are two ways in which you can look at this recovery. Of course, you can say, on the one hand, the economy has proven to be resilient. We've went through quite a number of shocks, monetary tightening, unprecedented, and yet we did not really go into a recession. The sacrifice ratio of the disinflation process that we had to go through was virtually zero. Unemployment did not budge. So resilience was there. But on the other hand, the growth was clearly not as abundant as it was in the US, and that is clearly remarkable. Now, I think there is a multiplicity of factors behind this growth differential, but if you allow me to single out the two most important factors in my view. First of all, fiscal policy. And this was not only about the size of the fiscal stimulus, it was also about the design of the fiscal stimulus during the pandemic. In the US, there was a choice for temporary layoffs, income support, and then rehiring when the economy reopened again. Well, that means that a lot of labor reallocation took place, and we know that such reallocation is very productivity enhancing. But in Europe, we chose a different approach. We chose an approach that was focused on job security. The governments essentially took over the wage bills of the firms. And as a consequence, we froze the supply side of our economy for a couple of years. Then during this period of stagnation, there was a lot of labor hoarding. which means that we have gone through a number of years where there has been hardly any labor or, for that matter, capital reallocation. So we have not enjoyed these efficiency benefits of reallocation as much as the US. And secondly, the economic impact, the negative economic impact of Russia's unjustifiable invasion into Ukraine were, of course, also much stronger on this side of the Atlantic than in the US. We are a fossil fuel importing area, so it meant that this was a very strong negative terms of trade shock, and this terms of trade shock of which we are recovering still also today. Now, on inflation, I think the picture is that I'm increasingly confident that inflation will decline towards our 2% target during the remainder of the year. This is mainly on the back of goods and food price inflation that is coming down. Services inflation has been resilient for a while, but we're now also seeing the first signs of improvement there. And that has everything to do with a slow but gradual moderation of wage growth, which is quite essential, I think, also going forward in making an assessment of inflation risks. But all these developments clearly point toward further disinflation. Also here, an intriguing question is, of course, is there more similarity or are there more dissimilarities with the development in the US? From the onset of the inflation shock, it was clear that the balance of root causes between, let's say, positive demand shocks and negative supply shocks was different in Europe from the US. The US had a much stronger demand component. I think we had a much stronger supply component. Yet at the same time, there was a remarkable synchronicity if you look at the development of actual inflation. So the bump that you've been seeing in the US, the question for us now is, are we going to see such a bumpy development as well? So far, we've not seen any evidence of it, but that's clearly a warning signal for us, also not to come with any sort of premature declarations of victory. All in all, I do believe that inflation is probably less persistent in the euro area than in the US. And that leads me then to conclude that if we manage to continue on this track, if the incoming data continues to validate this development, that it will be appropriate for us to gradually take our foot off the brake, to remove some of the restriction, the monetary policy restriction that we're currently imposing on the economy. The data that needs to confirm this, a lot of that will be available at our June meeting. We will have an additional data point on the labor market coming out next week, the triangulation between wage growth, productivity growth, and profit margins, which is important. Then we will have new projections, and I'm confident, again, that if they confirm the picture, as I just sketched it, that June will be a good opportunity to make a first move in removing restriction.
Okay. Very clear hint at June there.
Clear.
We'll come back to whether we could see further moves in July too. But just to draw on some of your comments there, you seem broadly confident that inflation is going to prove less of a problem in the Eurozone than it seems to be at the US at present. And we've seen quite a reasonably high PPI reading today from the US, Chair Powell. Some people have said that looks hot. What do you think of today's reading, and more broadly, is there a risk that inflation becomes a lot more of a problem in the US than it is elsewhere?
So we had a producer price index reading just a couple of hours ago, and I would say it's actually quite mixed. The headline numbers were higher, but there were backward revisions, and we're of course disassembling it, taking it apart, and looking at it. And I think markets and analysts are looking at it as I wouldn't call it hot. I would call it sort of mixed. But in terms of the overall picture for inflation, I think you have to go back to last year, where we had historically fast disinflation. Inflation came down by two full percentage points last year. Why did that happen? It's really two forces working together. One of them is just the reversal, the unwinding of the pandemic-related supply and demand shocks. So that we thought we would always get that. We thought we'd get it in 2022, and we didn't, and then it really arrived in 2021. So that was a big part of this, was just the reversal of distortions, really, to both supply and demand. The second thing is just restrictive monetary policy, and restrictive monetary policy cools the economy. and it makes room for the supply side to heal, but also lowers demand and ultimately lowers inflation. So I do think those two have been working together. And the question you ask is inflation going to be more persistent going forward? I think, and that would essentially mean that we've gotten the supply side gains that we're going to get, and now it's down to lower demand, which would take longer and potentially be more painful. I don't think we know that yet. I think we need more than a quarter's worth of data to really make a judgment on that. We know that there are still businesses still report that there are shortages and labor shortages and things like that, which are now being addressed. In addition, even when the shortage is alleviated, there should be lags before that shows up in economic activity and inflation. So there may be some more there. I don't want to give up on it yet at this point. I also think that having restrictive policy, we have the highest interest rates in some time. I think that it may be that takes longer than expected to do its work and bring inflation down. I am confident that we will do that, but that we will get inflation down to 2%, and ultimately we will do what we need to do with our policy rate.
And just to bring in a question that one of our members of the audience asked here, I mean, you referred to it briefly then, but from Edin at 𝐂𝐈𝐆𝐍, he asked, do you entertain the possibility that returning to the 2% target will not be possible with the current level of the Fed funds rate?
So I think
we got to stop printing money.
As I just mentioned, I do think it's really a question of keeping policy at the current rate for a longer time than had been thought. I think by many measures, the policy rate is restrictive. The question is it sufficiently restrictive? And I think that's going to be a question that time will have to tell. Entertain the possibility is, that could be a very small probability, but I have said that I don't think that it's likely, based on the data that we have, that the next move that we make would be a rate hike. I think it's more likely that we'll be at a place where we hold the policy rate where it is.
And is there any particular component of inflation that concerns you? A lot of people in the US have been focusing on housing and that segment, but is there that, or is it something else that?
So we think of it in three buckets, the first of which is just goods inflation, and goods inflation was negative for 25 years, mildly negative because, of course, globalization and many goods were manufactured elsewhere and shipped at lower costs. So that, I think, is performing broadly as expected over time. We had very high goods inflation at the beginning of the pandemic because of the supply chain issues. That came down a lot, and I think we expect that. Housing inflation has been a bit of a puzzle because current rents have been low. Current rent increases have been low for some time, but they're not showing up. That's not showing up in rollover leases and in owner's equivalent rent. So, I think what we've learned is that the lags between a decline in market rents and it showing up in the measured inflation for housing services is long. Their lags are longer than we thought. But as long as market rents don't go up, as long as they're going up at very modest levels, it will show up. It's just a question of when. I think our estimate of the lags is there, and so you've got to look at that. That may affect your confidence, but we have to wait for it to happen. In terms of the biggest part of it is services inflation, non-housing services, and that's more than half of the index. And it's less interest sensitive. It's very sensitive to wages and that kind of thing. We had made some progress there, particularly if you look at the market-based aspects of it. But that's the one that I think may take the longest. At the same time, it doesn't need to go to 2%. It wasn't at 2% before the pandemic. You need the three of those to come out in some way that they're at 2%. And I'm confident that we will get there.
Excellent. And just to go back into this theme of divergence, I mean, to summarize your answer, it seems that you think the geopolitical aspect of Europe being closer to Russia, and also the aspect of not only the scale, but the design of the fiscal response, are the primary drivers of this divergence that we've seen between the US and Europe.
Is it bullish or bearish?
What would your thoughts be on this? Are there other factors that you think are worthy of consideration when trying to understand why the US and Europe seem quite different economic beasts at the moment?
So I agree with all of the factors Klaus laid out. I would add we're probably also benefiting from a sort of strictly accounting GDP standard from new workers coming in to a large extent. I think the issue really is, and this is an issue that that the European economic policymakers are very, very focused on right now, is over the longer run, Europe's productivity growth has been about half of the U.S. And so ultimately all you've got is hours worked, and that's largely a function of population, hours worked and then output per hour. That's going to be your economic activity and growth. And so productivity is really the thing that can enable living standards to rise over time. And there are a lot of theories on why that might be. I think from an American perspective, I would tend to point to the more flexible labor market, and also a more fully built out set of capital markets, which is parts of which are very focused on funding early stage innovative companies. So it's not just a bank-centric system. We've got a very highly evolved financial system. That may be another factor.
Yeah.
Say something
Plenty
bullish,
of other
Chair
reasons
Powell.
there that are worth mentioning, I think. Turning back to you, President Knut, you gave a pretty clear signal, I think, that we're going to see a move in June. But a lot of the questions that people have put to us today have, stressed this point of, usually there's been this sense that the ECB has been following the Fed, and it's raised a bit of a question mark as to what degree can the policies of, the two major global central banks, with apologies to the Bank of England, how much divergence can we really see? So,
divergence.
To what extent do you feel constrained by what the US central bank does? And
I love her voice.
Would you perhaps be reluctant to cut in July? Should the Fed want to, stand pat and leave rates as they are for the foreseeable future?
Look, I think if you talk about monetary policy of big central banks like the Fed and the ECB, that monetary policy always takes place in a global context. I mean, our markets are interwoven to a large extent, etc. At the same time, we both have clear domestic mandates that look on an economy which may be 10-15% open, but it means at least 85% closed economy. So much of our inflation is actually being triggered still by domestic factors.
Battery 90%.
So what we simply need to do is construct our own inflation outlook, for the euro area. And yes, Fed policy is, of course, one factor that has an impact. And if you think about international spillovers, the first thing that comes to mind is through the exchange rate. If the Fed were to run a tighter ship than we were going forward, then probably that would lead to some dollar strength and euro depreciation, which of course leads to additional imported inflation. But at the same time, you will also have a spillover effect through global financial conditions. Bond yields internationally are also moving in tandem. If you look at the last few weeks and months, bond yields in the euro area have gone up significantly without there being a true euro area reason for doing that. It was just the spillover from the US. And that effect is, of course, disinflationary. So if you look at the two effects, it's not so clear which of the two will dominate. And it's therefore also not so clear whether the developments in the US will really have a meaningful impact on the inflation outlook in the euro area. I don't think it will change the direction of travel in the euro area that much.
So you'd be willing to cut in July too?
Well, we've been saying all along that we follow a data-dependent and a meeting-by-meeting approach. And I keep repeating here, it is essential what is happening in the labor market in particular, because services inflation is still the main remaining driver of inflation in the euro area. So we will simply have to follow the data as it comes in, both on underlying inflation trends, the labor market, etc.
Bitcoin's seen a little green here. Stocks reaching a higher high since the market's opened. It's about to get spicy.
Data-driven approach. And data, when it comes to the labor market, it's really about the comprehensive assessment of the labor market. It's too simple to just look at sort of contractual wages. Contractual wages are coming down. But one of the problems now is that we have negative productivity growth in the euro area. We had negative productivity growth in Q4. in Q1, again, it seems as if growth in employment exceeds growth in GDP, which means that probably next week we will get another negative productivity growth number. And that means that unit labor costs are actually still going up. And then the question whether profit margins are capable of continuing to absorb these unit labor costs, that's something that we really have to assess over time when we decide on future steps. So nothing, no commitment whatsoever, open mind for anything beyond June.
And just to turn back to the issue of US inflation for a moment, even though there's this sense that we did see a remarkable drop of inflation last year because it was just so aggressive the year before that there is this sense that there's still a public perception that prices are very high. How difficult is it to really feel as though you can keep credibility at times when trust in public institutions is under siege? And that's from Jerome Powell, who's from Leaders in Finance.
So I think for central banks, credibility is kind of everything, and we only earn that one way, and that's by achieving our mandate for the benefit of the public over time. And also, I would add, a part of that is sticking to our knitting. Don't take on politically fraught issues that are really not our mandate. Do your job and explain as best you can what's happening in the economy. Of course, the economy the post-pandemic economy has surprised everyone. I wouldn't single out any single central bank or group of forecasters. It's just been many things that were not supposed to be able to happen have happened. Nonetheless, we've made real progress on inflation. We're far lower than we were. I would say the risk that at the beginning we were very concerned that the very high inflation we saw might be quite difficult to bring down without a kind of very significant decline in employment and weakening economic activity. That didn't happen. That's just a great result. I think people are unhappy. You mentioned people are unhappy. That I fully appreciate that. And a big part of that, I think, is go to the store. Prices are high. You tell people inflation is coming down, and they think, I don't understand that. The price of all the things that I buy hasn't come down. So, they're not wrong. I mean, they're suffering. Particularly people at the lower end of the income spectrum are very hard hit by inflation from the start, which is why we're so strongly committed to restoring price stability and keeping it in place as long as possible.
And just to turn back to Europe now and to the Netherlands in particular, we're sitting in a venue here that's really testament to the power of trade for good and ill in an era of
Bitcoin breaking up here, stocks apparently leading the way, the dollar remaining flat. I knew this was going to get spicy.
Netherlands as a small open economy, and indeed the Eurozone as a very trade-dependent region, really thrive?
Yeah, that's a difficult question. I mean, it goes beyond saying that this is a development that is absolutely not a positive development for the euro area, and that we watch with a lot of concern. Now, fragmentation is there.
That's a strong
The train has left the station. So, I mean, we have to think about sort of the ways that it can manifest itself and what we can do to try to best redress its consequences. There is a sense that international business is actually, to some extent, more resilient to political fragmentation than we have been thinking beforehand. So that international trade is a little bit like a river that sort of tends to find its way, even if some obstacles are being raised here and there. But of course, the fragmentation, it impedes the diffusion of technology across borders, so that means lower productivity growth everywhere. I would also not underestimate the limitations that it puts on our capacity jointly and internationally to solve global problems. In a fragmented world, suppose we had a global financial crisis again, like in 2008, 2009. It would be much, much more difficult to get the G20 around the table and to agree on a concerted remedial plan as we did in 2008, 2009, think about climate change, etc. What can we do about it? Well, I think in Europe there is still a lot of untapped potential to at least strengthen our internal cohesion. we're not tapping the full potential of the single market. In many, many places, the single market only exists in a name. We don't have capital markets union. I think we are really doing ourselves a disfavor. We don't have a banking union yet. And so we are missing out on opportunities to strengthen international trade, or sorry, inter-European, I should say, trade and integration, economic as well as financial.
Would you have anything to add on this topic? I know it's something that's featured in the Fed minutes about the links perhaps between trade barriers and inflation and so on.
There you go, Bitcoin.
Do you see it as a risk?
So this is a very, very hot political issue, not just in the United States, but everywhere in the world. And not trade policy, of course, not the job of the Fed. So, I mean, we, as I mentioned a few moments ago, I think we need to resist the temptation to just have opinions on all different kinds of economic policies, as fun as that might be.
Let's go corn.
You know, the elected government has to deal with these things, and they have to deal with the public on them. And they've given us really important assignments, and I think we need to honor the decision not to give us that.
And I appreciate this is also an awkward topic, but it is deficits in the sense that the national debt is forecast to rise by the Congressional Budget Office quite substantially over the next 10 years. Does that make your life trickier as Fed chair rather too?
President.
I don't think it's not that it makes my life more difficult or the Fed's work more difficult, but I think it's you know, utterly non-controversial to say that U.S. fiscal policy is on an unsustainable path. Not that our fiscal position itself is unsustainable, but the path is unsustainable, meaning that we have full employment and we're running big structural deficits, and it's, you know, we're going to have to deal with this sooner or later, and sooner is a lot more attractive than later. I do hear from elected people on both sides of Capitol Hill and in both political parties that they do understand this. Mm-hmm. And I think you mentioned the Congressional Budget Office. I think everyone should be reading the things that they're publishing about the U.S. budget deficit and the path, and should be very concerned that this is something that elected people need to get their arms around sooner rather than later.
And you've noticed a lot, you've noted a lot that these supply side benefits that you thought might come, in 2021 or 2022 did actually arrive in 2023. Now, what sort of benefits from the supply side do you think we could see in 2024 and beyond?
So I think we probably have realized most of the reversal of the pandemic supply side effects, but not all of it. But I think we could get more sort of the final parts of the supply chains really getting sorted out. As I mentioned, the surveys of businesses, they still say there are shortages. They still say that they have a hard time hiring people, for that matter. So I do think we're still getting very substantial numbers of people coming to the country and going to work. Let me add, immigration also not a policy that the Fed works on or has opinions on, but I'm just giving you the straight economics of it. People come in, they can get a work permit, they are getting work permits, and they go to work and they're paying taxes and they're creating economic output, and there are millions of them. So it's alleviating the labor shortage that we had in the industries that really had it the worst. So I think all of that, it probably helped at the margin a little bit in cooling the labor market off. It's both supply and demand, but we think at the beginning, in the longer run, it should be neutral on inflation, but in the short run, it might have been positive. So I think that's a factor too.
And just to kind of turn to these like broader demographic trends, there's been a lot of talk in recent years about how they will impact inflation, whether they have some sort of impact on R-star, the kind of, the Goldilocks level of interest rates in the longer term, one might say. I mean, how do you think about these kind of longer term demographic trends and other factors and how they're going to influence where you see this kind of magical Goldilocks neutral rate of interest?
So the R-star, for those of you who aren't central bankers who read every word of every story Claire writes about us, R-star is really a longer run concept. R-star is a neutral interest rate that would neither push up on economic activity nor bring it down at some hypothetical future time when we're at full employment, we're at 2% inflation, and there are no shocks hitting the economy. So think 5, 6 years down the road, there's this sort of nirvana out there. Its relevance for current policy making is kind of limited, and I think you need to say that. Really what we're doing in an FOMC meeting is we're looking at the broad effect of the things that we're doing on the economy, and we're asking ourselves, is policy tight enough? Is it too tight? We're looking at what's happening in the economy. We're thinking about lags, and it's not a debate over the level of R-star, because that's a longer run concept. Now, and the argument is made that R-star will go up, and this is a debate that economists have been having for some years now, but the idea is, between deglobalization and the need to fund the energy transition and perhaps the need to spend more on military and the aging of the population, bigger deficits, higher, all of that could push up what is a neutral rate. And I think those are the interesting debates to have, but ultimately, we're not sitting around wondering what the longer run neutral rate is when we do policy. When we make policy, we're thinking today, is our policy delivering what the economy needs to move it toward the mandates that Congress has given us, stable prices, maximum employment.
So would you divorce it from, I think why this has come into focus, if you like, is because, now that, cuts are being considered in some parts of the world, at least there's this sense in which people are thinking, how low will rates go? Would you see that as part of the kind of R-star debate, or would you want to divorce the two factors of this current cycle and where R-star will end up being?
I think the R-star debate runs in the background, but again, it's a longer run
keeps breathing
concept.
Into the mic.
You could, if you wanted to think about a shorter run R-star, that would be more relevant. But that's not the way we think about it. We think about the effect of the things we're doing on financial conditions more broadly and on the economy. And how is it affecting the economy and why? And all of those things lead us to believe at this time that policy is restrictive and that it looks like it will take longer for us to become confident that inflation is coming down to 2% over time.
And how is this debate occurring around the table in Frankfurt at the ECB about longer run interest rates, or even, where are we going to end up? What's the rock bottom for this cycle?
Yeah, that's, of course, a difficult question to ask, because there are so many moving parts here. But what I would say is that if you look at the likelihood or the likely nature of the shocks that will hit us in the future, we came out of a
it's not me
period in which
breathing.
we had globalization, which was a slowly moving positive supply shock, ever more goods for ever lower prices coming from the rest of the world, which meant that for almost 10 years we continuously had to approach our inflation target from below. We had a low inflation problem. Going forward, with fragmentation, with aging of our societies, in my view, it's more likely that the shocks hitting our economy will actually be of the nature of negative supply shocks, not positive supply shocks. And if you think that through, that means that probably we will have to approach our inflation target more often from above than from below. And that probably suggests that we are not, that at least I don't regard it very likely, that we will move back to the time in which we had a continuous sort of our fairly persistent low inflation equilibrium with very, very low interest rates. We probably have to, on average, run a slightly tighter ship because of the nature of these shocks that are currently relevant to our economy.
And just to come back to something that I think has been kind of in the background here for quite a lot of the discussion about high interest rates taking possibly a while longer till they have the desired impact on some pockets of the economy. How do you see that? Is this a legacy of this very low interest rate era? And how do you really address that when it comes to monetary policy? That is there just going to be this lag from now on that didn't exist, say, relative to pre-2008?
So I think if you look at the bigger picture, we've seen the labor market's a good place to see this. You've seen demand for workers cooling off pretty substantially. The ratio of vacancies to unemployed people, for example, has gone from more than 2 to 1 to now 1.3 to 1, and it was 1.2 before. So that's a decline in demand. That's demand related. You also see wages coming down. You see quits coming down. So I think that tells you that policy is probably restrictive. I think it's also fair to say, though, that the U.S. economy is different this time for a couple reasons. One is that people financed themselves into very low rate mortgages, and now they won't move because they would be moving into a higher rate mortgage if they did, and they would be throwing a lot of value away. The same is true of businesses, many of which, as indeed you would expect, have termed out their debt. And so they're not feeling the effects of interest rates. So it may be that policy is hitting the economy not quite as strongly as it would have if those two things were not the case. Notwithstanding that, I think the overall picture still is policy is working, it's weighing on spending, it's weighing on interest-sensitive spending, and it's certainly weighing on the labor market. It's a question of restrictive policy. As I mentioned, our policy is the highest it's been in quite some time. The rate is, at 5.25% to 5.5% is high relative to recent history. So we think that it's probably a matter of just staying at that stance for longer, and that's how we're thinking about it.
And I mean, you note about housing and about the standard model in the U.S. being I think I'm right, the 30-year mortgage is kind of the standard mortgage product. I think here in the Netherlands, flexible rates are quite more fixed rates.
Yes, absolutely.
So fixed rates are quite common too, but I imagine
either or,
with shorter
10 or 15,
duration.
An average mortgage, I think, has an average maturity of like 16 years. Of course, that's a little bit endogenous because of the low interest rate period we had for so long that, of course, mortgage holders tended to extend the maturity. So now, lately, it's been coming in a little bit. But still, we have a lot of fixed rate borrowing in the Netherlands, and that has, of course, also mitigated the impact of the monetary tightening, which has been stronger in those areas where there is more variable rate borrowing. But in general, I would say 85% of all financial intermediation in the euro area runs through the banks. So when you look at monetary transmission in the euro area, you have to look at credit. And credit growth has more or less come to a halt. As a consequence, we increased policy rates by 4.5% within 14 months. Credit growth came to a halt. That was a feature of the policy, not a bug. And credit has been flat for quite a while. And now we're also beginning to see the first signs of life again. Now that there is an anticipation that our next interest rate move will be a reduction of rates. You also see the first signs of recovery in credit. So in that sense, I think this is more or less how you would expect monetary transmission to take place in the euro area.
And how much of an issue has that been for you in the US, where we do have this, where capital markets play a far greater role, and where, for reasons that were never quite clear to myself, the turn of the year, the markets were predicting, 6 interest rate cuts by the Fed, and pricing credit off the back of that, and there being quite a big, quite substantial growth in lending and refinancing over the first couple of months of the year. How much more difficult does that really make your task that the banks aren't as big a vehicle?
For what it's worth, it's a minority of intervention, but banks are still important, and particularly for small and medium-sized businesses that don't have capital market access. And credit has been tighter for some time now, particularly in the wake of the turmoil we saw earlier last year. But still, credit growth has been modest, and that's another sign of tight financial policy. So that's part of the picture. I think the fact that we have capital markets are so important for many consumer loans of various kinds wind up in the capital markets, are securitized and are not held by banks. It's just it's a very healthy credit machine for people, but they're feeling these higher. Those are short-term interest rates. I think that the ones that are longer-term interest rates are the ones where they're not feeling it, and that's really mortgages, and that's companies that have turned out their debt. I think other forms of consumer debt are short-term, and the surveys show that people think it's not a good time to buy durable goods like cars and washing machines, and the reason is it's a floating rate loan at a very high level.
Yeah, absolutely. And when you look at the banking system as a whole, you know, we've seen some jitters, I think, on both sides of the Atlantic, but you know, on the whole, it seems both systems are relatively stable, despite quite substantial rises in interest rates. Has that surprised you at all? Maybe first to Chair Powell and then to
Chair Powell.
President Knott.
Chair Powell.
Has it surprised? Not really. You know, our banks are particularly our large banks are, you know, strong, well-capitalized, very successful competitively, globally. You know, they're in a. I think one of the reasons why the recovery broadly around the world from the pandemic has been strong as opposed to the one from the global financial crisis is that the very large financial institutions came through just fine. The U.S. banking system overall is in good shape. Banks are making loans, as I mentioned. Credit conditions are a bit tight, but that's part of our policy. So I wouldn't say I'm surprised. I think you know, we obviously had a period of turmoil early last year, and we acted pretty quickly to stem the turmoil and also to, you know, to go to work as a supervisor and make sure that banks had good plans on liquidity, had capital, understood the portfolio losses that they have for longer run securities, and are in a position to understand and manage those.
Well, I think it's pretty clear that if you have such an unprecedented rise in interest rates in such a short period of time, that this constitutes a massive shock to the financial system. So when we were sort of in the process of tightening, of course, this was sort of enhanced monitoring, an area for enhanced monitoring. Now, I think we can say, so far, so good. I entirely agree with Chair Powell that the core of the financial system has held up quite well. And I think this is in part, I think the success of the financial reform agenda that was rolled out after the global financial crisis under the aegis of the Financial Stability Board, which was very much focused about stronger capital, stronger liquidity, stronger risk management at the banks, which were at the core of the financial system, and that has clearly paid off. Now, there have been some idiosyncratic accidents here, the second-tier US banking system, Credit Suisse, but I think there were idiosyncratic factors behind it. The banks that arrived into trouble in the US were not even part of the Basel III arrangement and the financial reform agenda. But I would say so far so good. The question marks today are much more in the non-bank financial intermediation space, where we have seen a couple of quasi-near miss accidents, I would say. The Dash for Cash, the LDI, the Archegos, the commodity traders in February 22. So these have all been pockets of vulnerabilities where you saw a combination of excessive liquidity mismatches combined with pockets of hidden leverage that we were unaware of before. And that is now also front and center of the work program of the Financial Stability Board, much more the NBFI space. Of course, we have to learn the lessons from the few banking failures that we did see, and that is continuous maintenance. But I think if you were to ask me, my main focus is more on the NBFI space than on the banking space.
We'll come back to Credit Suisse because I know that's a topic that you've spoken about quite a bit, and a few of our audience have got questions on that. But non-banks, would you share that, you know, that sense in which they're the big lurking danger in the financial system right now?
I guess I would say it this way. In the U.S., non-bank participants by non-banks in lending activities, for example, has been growing very, very fast. And it's a fairly new thing, and in many cases, whole markets are being now taken over, or now majority for non-banks. And so our job is to monitor that very carefully, because I'll say a couple of things. One, there hasn't been a downturn yet. You worry about very fast growth in anything. It just kind of raises financial stability questions, and you wonder, is it a bubble? What will happen, and will it deflate, and that kind of thing. And so you want to be watching it carefully. I will say, though, it's different. You know, some of the we've spent a lot of time looking at it. I just point to a couple of things. One is many of the lending structures are not subject to run in the way that banks have traditionally been. The funding tends to be from limited partners who have their investment locked up for many years, and they can't get it out. So as opposed to the danger with a bank can be that all the depositors want their money at the same time, and that's the traditional problem that we've been trying to solve with bank regulation for hundreds of years. But these are different. They don't have, and runs are responsible, bank runs or things like that are really responsible for an awful lot of the problems that happen in one form or another.
If banks could just have the money,
the non-bank financial
be a problem.
sector doesn't have that as much. Another thing is the ties between banks and the non-bank financial institutions are substantial and growing. So there's plenty of monitoring for us to do there. It's not obvious to me that at this point that it's a net loss to financial stability, but I would say our jobs are to monitor it very carefully and thoughtfully and understand the implications.
And just to return to the topic of Credit Suisse, we had a question
Credit
submitted ahead
Suisse.
of the event. In your keynote speech at the 7th Annual Conference on European Systemic Risk, you talked about events surrounding Credit Suisse. What can the Foreign Bankers Association, to which we're speaking today, and the Netherlands Bank learn about the collapse of the Swiss lender?
Well, I guess the main thing one can learn about the collapse of Credit Suisse is the huge importance of governance, governance within financial institutions, because it is pretty clear that the events that led to the failure of Credit Suisse were not sort of a classic lack of capital or, let's say, too much credit risk relative to the capital. It was management failures, there was outright fraud, there were misinvestments, there was misbehavior, even at the top of the institution. And if you have a series of governance failures at an institution, it will lead to an erosion of confidence. That erosion of confidence will lead to deposit runs, which, by the way, already took place much earlier than March 23. There was already a significant outflow of deposits also in the fall of 2022. And so we have to remind ourselves, it is not only about capital and liquidity. Governance of financial institutions is of utmost importance.
Dollar
Are
dumping.
there any questions about AT1s
Timber.
and the treatments of those particular instruments that you think can be drawn in the Dutch context?
Yeah, of course, there was a case where AT1s have been completely written down. So I think it behooves us to look a little bit deeper into this issue, why the AT1s were drawn down, whereas equity was not fully written off. This was, by the way, completely in line with the contractual provisions of the AT1. There was just that not all investors had really read the contractual provisions, so they pretended they were surprised by it. But I think from every case, I think we should try to draw some lessons. But in this case, at least, it allowed the authorities to write down 16 billion Swiss francs, which was helpful to generate the interest of UBS to actually take over.
And now turning back to you, Chair Powell, we've got a very nice question here from Liu Zhan from ICBC, who asks, during COVID, the Federal Reserve applied high levels of monetary stimulus to further raise asset prices and support growth. Bloomberg called you Wall Street's head of state as a reflection of how strong your actions were on asset prices and how profitable your actions were for Wall Street. How does that make you feel, and how do you look back at this with the benefit of hindsight?
It makes no point of contact with the way I remember those days, so whatsoever. So I would just say this: if you put yourself in the place where we were in March of 2020, no one knew how long it would take to have vaccines. No one knew whether millions of people were going to die fairly quickly, or how long the economy would remain closed, or was it even going to be possible to reopen the economy if it had to be closed for a year? What was that going to look like? So I think it was it was so uncertain that I came to the view, and my colleagues did too, that we really needed to use our tools in ways that we hadn't before. Because I would never have been, if things didn't work out, I didn't want to, if we had to go through a really deep, lengthy downturn, I would not want to have to explain why we didn't do that. So we did, and what happened is we announced these very aggressive, vigorous programs to support markets that we had never had to support before, the municipal market, corporate debt, these were red lines that we said we'd never cross. But the thing is, when we made the announcements, the markets healed themselves. So we made very, very few loans. We had something like $6 trillion in lending capacity. So the announcement effects of the things that we did, it really worked this time. So I think broadly speaking that the initial response was very successful and involved ultimately very, very little in the way of actual lending, a lot of announcements. Then the story goes on, and you have the reopening and the inflation, and we're still living through that. I think we'll have to judge that from a greater distance.
Anything you'd do differently in retrospect?
There's nothing I would do differently in the initial response. I think we did very well, and I think that the world continues to benefit from the strong response that we took, and we really avoided an awful lot of bad tail risk there that could well have come due. Again, I would say on inflation, when inflation kind of unexpectedly arose in the first quarter of 2021, I think we're going to need to, I've tried to resist reaching, conclusions about that episode until, it looks so different now than it looked a year ago, for example. All the progress we made in 2023, I think we're talking about it in a completely different way now. I think 2-3 years from now we'll be doing the same. So I don't want to try to learn lessons, in the middle of the story.
Sure. I think that's very fair. And another question here that's just been submitted from Abir, who asks, is Chairman Powell confident about the degree of independence of the Federal Reserve in relation to the executive branch of government? Do you think you have the powers that you need to defend your independence?
Yes, without question, I do. I think when I talk to elected representatives in both political parties, in the House and the Senate, and I think there's very strong support on both sides of the aisle, on both sides of Capitol Hill, for an independent Fed. I think people do understand that we're just there to do our job on a non-political, non-partisan basis. Nobody's perfect. Everyone makes mistakes, but the Fed is doing the absolute best we can with the tools that we have and the understanding of the economy that we have. I think that is very broadly understood and supported on Capitol Hill. So I'm less worried about that than the sort of things that have been in the press lately might suggest.
Okay. The same question to you. Do you feel as though the ECB's independence is well enough enshrined?
Oh yes, I think the ECB has one of the strongest statutory independencies of maybe all central banks in the world. And let's zoom out just for one moment. I mean, this inflation shock that we had, if you compare it to the previous inflation shock of the same magnitude, which was the 1970s, when we didn't have independent central banks, the main difference why I think now we have a credible prospect of getting the problem under control within, let's say, 3 or 4 years, while in the 1970s it took 10, 12 years, and the disinflation was so much more painful. The sacrifice ratios were so much higher, high unemployment, etc. The big difference is central bank credibility. During this huge inflation wave, inflation expectations continued to be well anchored. They never drifted away from 2%. This is so different to the 1970s. And why were inflation expectations so much better anchored this time around? Of course, you can have a debate about it. It's about psychology, etc. But I would posit that the higher degree of central bank independence is clearly an integral part of that story. So this is a very tangible way in which we can show to society the benefits of having independent monetary policy making.
Would there be anything that you'd like to add to that on the case for central bank independence?
I think Klaas said it very well. I mean, and I think in the United States we don't have the quite the constitutional, I think, support that you have for it. It's a statutory arrangement. It's an institutional arrangement that has benefited the public. And that's all it is. Congress can change it any time they want. It would take Congress to change it, though. There's nothing the executive can do. Again, I don't think that's likely, but as long as what we're doing is keeping our heads down, working on the things we're supposed to be working on, doing our absolute best, and explaining ourselves as best we can, acknowledging mistakes, and going forward, and that we will have the faith in our independence that we need, and I think we do have that now, and I'm determined that we'll continue to have it.
And I think that's a very suitable note to end this discussion on. I'd like to take this opportunity to thank the Foreign Bankers Association for putting on this wonderful event, the organisers Richard and Maxine, 𝐂𝐴 Media, our audience here, and many of you joining online, and of course our panelists. Both of you have been superb. Thank you for joining us, and enjoy the rest of your day.
I could listen to her talk all day. I could listen to her talk all day. You know what else I could listen to all day?
Chairman Powell, he ain't playing this a blur. Gotta follow the data, ain't no time to err. Watch him speak now with that Tom Crown flair. Yeah, Chairman, he's the captain of the crew, navigating through the markets, knowing what to do.
Don't buy this, please. But do subscribe. Smash the like button. Join the Discord.
Chairman Powell making paper every hour. Chairman Powell, he got that money power. Data on his side, watch him rise and devour. Yeah, he's the chairman of the board, making moves that empower.
Dollar showing some definitive weakness here. Bitcoin potentially painting a higher low after a double or triple daily top at 63,470. Let's retake that price. Let's get back up there, boys. That dollar weakness. Look at this hourly candle into Powell speaking. Just a free fall, breaking some structure here from May. Looking to retest those lows. I thought stocks were going to rip for a second. GME. I think we're going to see another flag paint out here. I think we're going to see higher prices. Bonkers. Just bonkers, dude. AMC, likely the same thing, just slightly less. Just an oscillator for GME that is under-exaggerated. GME, the S-coin. Stay away from this, guys. Please don't get wrecked on something like this, but do you. As always, I'm not here to tell you what to buy or not buy, but I wouldn't touch this. It's wild. Yeah, boys. It was an early stream. We did it. Make sure you join the Discord. Sign up with any of the partners in the video description below, and you'll get exclusive VIP access in there to our trading rooms. What do you got to lose? 𝐂𝐴LGO. You get a 1-month risk-free trial. Use my link. What do you... Give it a shot. Now is the time to invest in yourself. Level up your skills, guys. We're going to be live again tomorrow. Shout out to MetaSignals as well. We're going to be live tomorrow. I'm glad you guys joined for this early morning stream. I'm wearing these shades. Thank God I could just kind of sleep during it. I didn't really sleep. Anyway, wonderful. I'll see you guys soon. I'll be in the